So how do you legally avoid capital gains tax when you buy and sell something? Well, I'm going to tell you the best way in real estate is to do a 1031 tax deferred exchange. So what is that? Well, what that is, it's a vehicle that the IRS has come up with which allows you to transfer your gain from one property to the next, okay? Now there's some regulations and rules regarding this. You have so many days to pick a property and then so many days to close on it. But it's a fantastic way to just kick that tax can down the road, okay? Now ultimately, if you ever sell that last property, you're going to pay taxes. But the game plan here is you keep buying and you never sell and you'll never pay taxes on the gains you make from those properties. I'll give you the second great way, and that's cost segregation, where you cost segregate a property and accelerate the depreciation. In all real estate, there's something called straight line depreciation. It's 20 years. You're depreciating the asset above the ground. Everything that's above the ground, you're able to depreciate the walls, the ceilings, the windows, the doors. They all have a remaining life on them. And the IRS allows you to depreciate them as a tax benefit. Well, cost segregation accelerates that process, okay? An engineer will come in and they'll tell you how many years you've got left on the carpet, on the walls, on the ceilings, on the lighting, and massively shortens that 20-year time frame. And then you add bonus depreciation on top of that. So this year it's 80%. Next year it goes to 60%, unless we have an administration change and they reverse that stupidity. But the bottom line is that's how you avoid capital gains, either through a 1031 exchange or doing that cost segregation business when you buy an asset. Now, you're not going to avoid the tax when you sell, but you'll mitigate it when you buy a new one and do this cost segregation study. Hope that helps.